My name is Mike Salco, and this is video 3 of 3 of a three-part series accompanying the case materials that you should have received as part of the UCLA Credit Suisse second annual investment banking case competition. In the first two installments of this video series, we went over the first 4 tabs of this UCLA case competition template model that we received from Julien Debinet at Credit Suisse. In this installment, we're going to be going over the last 2 tabs of this model, titled Outputs and Case Comparison. So, in the past 4 tabs, you should have put in all of your inputs, and there are actually no more inputs to put in for outputs and case comparison. However, these last 2 tabs are good for self-reflection and just to see how your model is operating, and they'll also be useful in terms of gleaning the information that you're going to want in your presentation for Credit Suisse. So starting with the Outputs tab, you'll see in the upper left-hand corner we have a table titled Sources and Uses. So this is a summarized version of the Sources and Uses table that we put our inputs in on the Model tab. And you'll see that we have a summary of our capitalization structure. Starting with our more senior debt tranches, we have our revolver, then our first lien term loan, second lien term loan, our senior notes, and finally our sponsor's equity. So one of the things you want to pay attention to on this table is the percent of total capitalization, just to make sure that you do have healthy amounts of equity and debt, and that your debt tranches are spread out how they should be. Moving on to the uses below sources, you'll see that we have cash to balance sheet, and as Julian reminds us, that is our net balance. So while we do have $91 million on the pro forma balance sheet, the cash to balance sheet in this portion of the uses table is our net balance, which is the cash to be used on the balance sheet minus the cash that we are getting from the balance sheet before the leverage buyout. And because we're not drawing down that cash in the pro forma balance sheet, those two balances should equal each other and zero out. Then their second use is to refinance any existing debt on the company. You can see that in this example, they have $1.2 billion of existing debt that we need to refinance. We then have almost $13 billion worth of an equity purchase price, and finally $196 million worth of financing fees and other expenses. And your sources should equal your uses, and that should give you a very succinct description of where the money is coming from and what we're using the money for in this leverage buyout. Moving on to the pro forma capitalization table, we get into a little bit more of the details as to how expensive this debt is and what our debt service is looking like. So as you can see, it follows a similar format as our sources table. However, we've got our interest rates on there, so LIBOR plus 400 for the revolver, LIBOR plus 425 for our first lien term loan, and LIBOR plus 800 for our second lien term loan, and then 8.3% our senior notes. And you'll see that our total capitalization also adds up to the total uses, because these are our total sources. And then below the cap structure there, we have some operating statistics. So our adjusted EBITDA for our 2015 pro forma EBITDA or income statement there. Then we have our net cash interest expenses and our capital expenditures. So you want to make sure that these interest expenses and expenditures do not surpass our adjusted EBITDA, as that would mean that we are not earning money on a net basis. Year to year, we're not going to be able to pay down our debt because our income or adjusted EBITDA, which is a proxy for our free cash flow, does not exceed our interest and capital expenditures. Below that, you're going to look at your credit statistics and just make sure that you're not too levered on any of your tranches. So you can see our first lien debt is 2 times our EBITDA, and our total debt is 4 times levered over our EBITDA. And you just want to make sure that those aren't too far levered. Below that, you have our adjusted EBITDA and our net cash interest expense. and adjusted EBITDA minus capex and cash interest expense. So those are your interest coverage ratios, and you just want to make sure that your EBITDA does cover your interest expense to a healthy degree. And again, rather than estimating what a healthy degree is, you should go online and look up previous leverage buyouts and see what their interest expense coverage ratios are like, what their leverage ratios are like, and make sure that your deal is in line with precedent transactions. And finally, you want to look at your total debt to your total capitalization, and just make sure that your debt is not making up too much of your total cap structure on a pro forma basis, because again, no lender is going to lend you an absurd amount of the deal, right? They want to see that the financial sponsor is putting up some of their own cash and that sponsor's equity is making up a significant portion of the debt structure, or rather cap structure, sorry. Moving on to the free cash flow summary. This is where the bankers at Credit Suisse are going to look more at your projections and how they flow into the free cash flow that will then be available to pay down the debt. Because remember, the profitability from this leverage buyout is coming from the ability to pay down the debt that we used to purchase this company and increase our sponsor's equity share. So on this table, you can go ahead and make sure that your revenue projections and your EBITDA projections are transferring nicely to free cash flow, and that you are able to pay down your debt. So you should see balances on your revolver and your term loans decreasing as we go from left to right as we go forward in time here. And then again, you have some credit statistics to summarize and make sure that your debt and interest expense are at healthy levels. Finally, moving on to case comparison, this is where the bankers at Credit Suisse are going to be able to see just how optimistic your upside case is and just how much of a margin of safety you have on your downside case. So this is a summary of all the assumptions that you've made in your model in terms of operating statistics and operating margins. So you can see that we're looking at our total revenue here, gross profit, adjusted EBITDA, and then free cash flow. So this is where they'll see how optimistic you've been getting on your upside case in terms of projecting out revenue, and in a worst case scenario where if the shit were to hit the fan, just how optimistic that downside case is and whether you'll still be able to have significant free cash flow in a downside case to pay down your debt. So just to summarize, these last two tabs are not tabs that you need to be putting inputs on. As you can see from the black and green numbers, they are pulling from other places in our model. However, they're good for self-reflection, just to make sure that everything in your model makes sense. Debt levels are healthy, you're paying down your debt as well as your interest expenses, and that it will be a profitable LBO. This has been part 3 of a 3-part series of a somewhat video guide for the UCLA Credit Suisse Second Annual Investment Banking Case Competition. If you have any questions, I believe my email is in the packet that you received, but if not, it's michael.salco@ucla.edu. Please feel free to reach out if you have any concerns. Thank you.